now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Good morning and welcome to the Hump Day edition of The Real Investment Show. Danny Ratliff joining me this morning. Talk a little bit about recession, economic slowdown, lots of stuff in the headlines as of late, so we'll talk a little bit about that today. I've also got an article coming out on Friday as well discussing that, but we had some data out yesterday that kind of feeds into this kind of this kind of debate that's going on within the markets, as well as really kind of the political environment as well. Lots of headlines out. UCLA just issued, they've been issuing recession data, I guess, or recession alerts. Not really even alerts, just they talk about recessions, I guess, since like 1950. So when if you want to know what's happening in California, go to UCLA. They issued their first ever recession watch yesterday. So first ever since 1950, they've never issued a recession watch. It kind of begs the question, not being cynical, if this is your first ever recession watch, what did you issue before? Like, hey, the recession happened. in review. So they issued their first ever recession watch based on concerns about, Orange Man bad, tariffs. This is going to, all these policies are going to be bad for California as well as for the U.S. So they've issued that out. But we'll talk a little bit more about that this morning as to, what the data is saying right now. And of course, there's always risk of recession. But, we talked a lot about that in 2022. Everybody expected a recession in 2023. That didn't occur. So we'll get into that this morning. Also, 4 out of 5 doctors all suggest, and have you ever wondered about when you hear these things like 4 out of 5 doctors, 99 scientists, 99% of scientists say there's climate change, whatever it is. It's always these numbers, right? So you always have to look at, well, who did you actually survey or sample, and why was there always one doctor, right? Yeah. Who was the one doctor they sampled that said, gum doesn't, taste good or whatever, right? Whatever the issue is. 99% of economists that are surveyed right now say the Fed will not cut rates today. So today is the Fed meeting, and there's a 99% probability the Fed will not cut rates today. I'm just curious who the one guy was that says they will. So we'll see what happens. There is a very high probability the Fed will not cut rates today. There's not really a lot of concern in the financial markets. Yes, stock markets have corrected by about 10%, but credit spreads remain very low. There's no real risk of banking issues right now. The economy's doing okay in terms of the recent economic data. So again, there's not any real setup here that requires, at least at this moment, any type of action by the Fed today. We'll see what happens, and we'll talk about it some more tomorrow when we actually get into their statements and see what Jerome Powell says at the meeting today, or at the presser today. But again, we'll get into that. But again, as of today, there's just really no indication that the Fed is going to cut rates. But I guess there's always a possibility they could do a surprise rate cut. But I think the thing to watch for today is any type of comment about quantitative tightening. They had talked previously about we talked about this last week, that at the prior meeting, the Fed had made the comment about stopping quantitative tightening while we were dealing with the whole debt ceiling, government shutdown issue. That's now been resolved. So now will the Fed restart QT, or will they just not say anything about it and just keep QT paused at this moment, and as we kind of go forward? So we'll get a lot of that data later on today. That will certainly move markets this afternoon, and then we'll talk about it tomorrow where we are. Speaking of the markets, here's what you need to know before the bell this morning. So again, we had 2 days of a fairly strong rally. Markets kind of rebounded back a bit, headed back up towards that 200-day moving average. Did sell off yesterday somewhat. And again, that's not really that surprising. That really doesn't change the outlook for the markets right now too much. Markets are very oversold. Kind of trying to form a bottom process here is not going to be, easy after the recent decline, because when you have these type of actions in the markets that are very quick, and you have these sharp downturns, it creates what's called trapped longs. And these are individuals that got swept up in the sell-off, and they're like, oh, I want to sell, but I'm going to wait for a bounce to sell into or whatever it is, and then the market just keeps going down, and so they're kind of trapped in the sell-off. So when the market does finally bounce, they're like, okay, there's the bounce, I'm getting out. And so you kind of get these waves of selling that come in as these trapped longs exit the market. But momentum is trying to improve here a bit. That's good news. Relative strength has turned up here a little bit. That's good news. What we would really like to see here is, and again, over the next couple of days, this market kind of try to push up here a bit. See some buying come into the markets. If we can see money flows start to turn positive, that'll be a better indication that you're actually trying to form a bottom here. Would not be surprising, as we've talked about before, is that this market could come back down and retest these recent lows. So again, we have these lows that are kind of set in the markets. Markets come down, retest that low before you get a bounce and kind of form that bottom. That would not be surprising here at all for that to occur. So again, this market could be real sloppy here over the next couple of weeks. You've got a lot of overhead resistance sitting here right at the 200-day moving average. You've got the 20-day moving average that's now coming down to kind of coincide with that 200-day. So again, there's a lot of overhead resistance. The market's going to have to really work to try to get through that. So that's going to take a bit of time here. And probably a bit of frustration to try to get back up through those levels and eventually start to put the market back on more bullish footing. So expect this kind of consolidation corrective action to continue here for a little while longer. It's going to be frustrating, but again, there's just some markets just don't go straight up all the time. These are just things that we have to deal with, and having these corrections are completely normal. Again, there's no real indication right now of a bigger unraveling of the markets at the moment. There's actually a good setup here from sentiment and other areas when looking at the markets for a rally. And remember also, too, we're about to go back into earnings season, so earnings will become supportive of these because earnings estimates have been slashed quite a bit here over the last month or so for the next quarter. So for first quarter's earnings, those estimates have been slashed pretty dramatically. So as we get into April and start reporting first quarter earnings, there's going to be a higher beat rate because of that reduction in earnings estimates that haven't really impacted companies yet. So again, that's going to kind of filter in. So that should give some support to stocks as we get into the month of April. But again, between now and then, certainly expect a little bit here, more volatility. Continue to kind of manage your exposures, your risk, etc. As we kind of work through this process. Again, it's markets can't always go up. Sometimes we have to go through these corrective phases. That's all that's happening right now. Nothing really more than that at the moment. Moving over to bonds real quick. Bonds have been continuing to try to, been providing a decent hedge for portfolios as well. We got really kind of overbought a couple weeks ago. We talked about the fact that, hey, we're really overbought here. Expect kind of a pullback. Got that pullback, came down to support, sitting right here at the 100-day moving average, trying to hold that support level right now. Relative strength is trying to improve here a bit. So again, there's a possibility, depending on what happens with the Fed today, we could see a move in rates back up to around 92 on TLT. That put us right around 4.2%-ish, 4.1.5 on the 10-year Treasury rate. So again, much better bullish kind of action within the Treasury markets, really kind of going back to the beginning of this year. We've kind of got this whole trend of rising bottoms at the moment, which is certainly giving a better level of support. And I'm going to get my computer to work here for me. We've got this kind of rising trend that's going on right now with the TLT and bond prices. And of course, this is working itself into a wedge here a bit as well. So again, if we can get a move up in bonds, that should give us a better move higher later this year, because that would coincide with weaker economic growth, lower rates of inflation, as the impact of tariffs and other stuff that's going on right now, reduction in government spending, starts to weigh into the economy. Wages are declining. We're starting to see the slower wage growth, weaker employment as well. That should all feed into higher bond prices here later this year. So if we can move out of this kind of consolidation pattern and get above the 200-day moving average, it's a really good setup for bonds later this year. But again, we're just going to have to kind of work through this correction process right now. All right, that's what you need to know before the bell this morning. We'll come back, talk about recession or economic slowdown with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me. Danny, good to see you.
Good morning. Good to see you.
How things going?
Great.
Awesome. So, a couple of things kind of going on. By the way, I'm very disappointed in you. And Richard, both, by the way.
I can't
Very
wait to hear
disappointed.
why.
Because I was online yesterday and got an ad that popped up, one of these video ads that popped up on my screen. And it's for a new book that's just come out. It's called I'm Dead, I'm Sorry. And it's a binder, and you open this binder up, and it's basically a walkthrough of everything that you need to prepare to give to your family. You know, so when you pass away, here's all my bank accounts, here's all my, here's my love letters to you, here's, my letters to my kids, this is where my insurance policies is, all the people you need to contact. Just really well thought out, called I'm Dead, I'm Sorry. Or I'm Sorry, I'm Dead. That's the name of it. And I thought y'all should have done that first, so somebody beat y'all to the punch.
Well, there are a lot of those out there, and we've actually talked about doing something similar and a number of other things, but, there's that thing called time. Mm-hmm. There's not enough of it.
There's 25 hours in a day, Danny. You're wasting an hour of it.
And we use all 26.
No, exactly. But no, I did think it was really funny because it's this black binder and it says, I'm sorry, I'm dead on the cover. And then you go through this whole process.
No, but that's genius. And, that's, for a lot of people, they do need that kind of just something to really a reminder, like what else should I be thinking about? What should I be doing? And so that is something that we talk about often, like, hey, make sure you have all of your affairs in order. But most people think it stops at the will or a trust or any of the documents that they have from an estate planning perspective, but really it goes much deeper. And I've seen, unfortunately, you do this long enough, you go through this quite a bit, but some of the most really well thought out, these guys go as far as creating their eulogy. And I like that in a lot of ways too, because, everybody in their eulogy, if you're writing it yourself, it's all things you want to be.
Right.
And so now you've got to own up to it and say, oh, well, I'm this type of person. I'm this. Are you full of crap or are you really, right? And so you kind of write that before, and I've heard people say that if you start thinking of it in those terms, it'll create the type of person you should strive to be at all times, which, things happen, right? I mean, I was visiting with somebody yesterday, and they said they have a road rage indicator, and their road rage indicator's gone way down lately. I'm like, what's changed for you? Well, I had to turn everything else off. I just listen to Christian music. That helps them, right? I'm like, good for you. But those are the things I think that are overlooked. Like, what are your online passwords is a big one. Right. We've got all the other stuff in a row. The eulogy. What do you want at your funeral? Because you got to think this is an emotional time that many people just it's challenging. No, you don't want to make these decisions. What would they want? I've always told Michelle, my wife, I said, hey, if we ever started another type of business, it needs to be around weddings, it needs to be around funerals, and it needs to be around babies being born.
Right.
Because everything's emotionally charged with that. I mean, I remember the first time we looked at furniture for our newborn, who, Abby, happy birthday. It's her birthday today.
Happy birthday, Abby.
She's probably still in bed.
Yep.
But it is we were looking at furniture, and you get caught up in it. Like you see all these things, especially women go on social media and they say you need this, you need that, and I thought, what? I said, Michelle, do you remember what your crib looked like, or your bed set or dresser or any of that when you were an infant? No. I said, me neither. So what? We're not doing this.
Right.
This is crazy, but people are doing it left and right.
I know. It's funny how these things kind of catch on. I mean, we told our kids that when my wife and I pass away, that we want them to cremate us and then take us to Italy and dump us in the ocean in Italy, right? I have a feeling it's going to turn out, and of course we'll provide them all the money for the tickets and all that, right? I have a feeling this is going to turn out they're going to order a pizza and dump us in the toilet, but knowing my kids, I don't trust them, so I may have to have a third party kind of make sure we get to where we're supposed to be.
A trustee of ashes?
Exactly.
The executor who's going to hold on to it?
Exactly. It'll be like, we got them as far as Galveston.
Oh, that's great.
So we'll kind of see what happens.
But those are things that you can think about and start to take that off of people's plates. And that, while it is an emotionally charged time, that people can begin to think of like, okay, what do I really want? How do I take that burden off of my family as they're grieving? And the people that have done that, I can tell you, their family is so thankful.
Oh yeah.
I mean, so thankful.
It's such a mess when you go through the passing of family member, that you've got to go and try to sort stuff out and try to figure out where their bank accounts are, where do they have an insurance policy? Do they not have an insurance policy? Where's all their, stuff, right? It's just very difficult. And then you're trying to deal with that. And then the emotional issues that go with the passing of somebody all at the same time. It's just a terrible thing. So if you can make it easier on somebody, it's better.
Yeah, it's a great idea. I highly encourage people to do that if you have not already. I mean, the basic thing you could do is just go check beneficiaries, number one. That's an easy part. Every year we encourage people to check beneficiaries, especially if you're moving accounts. We see a lot of times that, old 401ks, things, it's an ex-spouse or a girlfriend or, a family member that's passed, and then they've never touched it again. Mm-hmm. And I know there's a lot of you out there right now with a bunch of 401ks floating around that you may not have looked at even in a long time, because I hear from y'all. Make sure those beneficiaries are updated, because you may have, we've heard stories and seen people that have been married for years or decades that they've never changed that, passed, and then you got a big fight on your hands.
Well,
there's not much you can do.
Well, that, and then look, we just had a client just pass away here just a couple of weeks ago, very unexpectedly, had opened up some IRAs with us, and no beneficiary was assigned to it, and so then that just winds up in the whole process of probate and everything else, and it just makes things difficult.
Well, and so we do see that sometimes. Somebody they're in a rush to get something set up. Let's go ahead and do that, and so they transfer funds, and they say, I'm going to get back to that. And so we always encourage, like, hey, as we're setting it up, go ahead and set the beneficiaries now, so it doesn't get lost in the weeds, and we don't forget about that. And we look back, and we're looking back and saying, okay, hey, is everything set up properly? Do we have the account allocated correctly? Are beneficiaries on the account? And sometimes people say, well, I'm not going to worry about that. I have a will. But you have to remember, if it's pretty simple and you just want it to go to XYZ, even your spouse, go ahead and get that set up, because all they need to do is bring in a death certificate versus bringing in, going through probate, bringing those letters of probate, going through finding out who the executor is, which really it just costs time and money. And it's unfortunate when we can get around that rather easily.
Right. Yeah, no, and just, again, these are those little small details that you want to pay attention to. And again, it's just, kind of morbid, but those are things that we don't want to deal with because you have to deal with mortality.
Yeah.
And, none of us wants to admit that we're going to die eventually.
It's never going to happen, right?
Exactly. Well, you're not going to let me because I keep trying to retire and you won't let me retire either. So I figure death is completely off the table.
That's probably a better option. I mean, I can't stop that. No, your financial plan does not work, Lance.
And death doesn't either, apparently. So there we go.
You've been trying.
I know. I keep trying. I'm gonna figure a way out of this. So at some point. Anyway, got a few things to talk about this morning. Recession or economic slowdown. As I said this morning, UCLA just came out with their first ever recession watch, and again, just kind of makes me chuckle. You've never put out a recession watch before, but now you do. But it is from California, so that explains kind of a lot. But we're seeing a lot of this in the headlines right now. 40% of economists. Now this was up from basically about zero a few months ago. 40% of economists are now expecting a recession. So we're starting to kind of get back to where we were in 2022, where we had a large number of economists were expecting a recession, and the question is whether or not a recession is going to occur. That's kind of the big if, right? Because if you have an economic recession, what does that mean? Well, that means that earnings are going to slow rather dramatically because you have slower economic growth, and slower economic growth or negative economic growth is where earnings come from. So all of a sudden, all these estimates for earnings that the market's been trading off of have to get reversed. And so the question is now that we're having this 10% correction in the market is, oh my gosh, is this the precursor to a recession? Because the market does tend to lead the economy by about 6 to 9 months. So is this 10% correction, and this is the question that Danny and I'll talk about when we come back from the break, but is this 10% correction the foreshadowing of a recession in 6 to 9 months, or is this just a correction, right? And this is going to be kind of the big issue. But this is part of what the Fed's going to be dealing with. We're going to later on this afternoon at 2:00, we'll kind of get the announcement from the Federal Reserve on what their outlook is, because this is also the quarterly announcement for the Fed, which means they will also today issue their quarterly projections for the economy, for interest rates, for the Fed funds rate, for personal consumption expenditures, all the things that they're looking at economically. All those projections will come out today. So all eyes are going to be glued to those projections to see if the Fed is starting to think that we're going to have much slower rates of economic growth, or potentially is there a recession in the near future. So we'll have that data as well today to talk about tomorrow also on the show. But when we come back, Danny and I will kind of get into this. Headline of the CNBC Fed Survey: slower economic growth is likely ahead with the risk of recession rising. Talk about that next. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'm sure when you were growing up, your parents said, don't get in a car with a stranger, especially white vans with no windows on them. Don't get into those if they're offering candy.
The Real Investment Show podcast.
And then now we've evolved to this point. It's like we can order a stranger with a car to come pick us up off of our phone. Uber just announced that they are opening up a wait list for Waymo rides in Austin. This is the driverless taxis, which is cool.
At realinvestmentadvice.com.
So now I'm not going to get into a car with a stranger. I'm just going to get into a car with no driver and watch a Roomba go around Austin trying to navigate busy streets.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, CNBC's Fed. This is a CNBC Federal Reserve survey, and this is kind of the snippets from it. Respondents to the March CNBC Fed survey there's more than just a few Fed members you know of, right? There's lots of Fed members all over the country, so they survey them, and this was reported by Steve Leisman, who has stage 4 diabetes. But as we talked about yesterday, one of the worst economists on the planet. Respondents to the March CNBC Fed survey have raised the risk of recession to the highest level in 6 months, cut their growth forecast for 2025, and hiked their inflation outlook. This is completely backwards because you can't have slower economic growth, risk of recession, and higher inflation. Those just don't work together ever. So just because inflation's a function of economic activity. So when you're getting towards stagflation, right? Well, no, and they have stagflation. Unemployment. Yeah, you got to have higher unemployment. So and high inflation, and you're just not going to get either one of those. Anyway, much of the change appears to stem from concern over fiscal policies from the Trump administration. Tariffs, of course, which have now seen kind of as the top threat to the U.S. economy, replacing inflation.
And the outlook for S&P 500 declined for the first time since September. 32 respondents include fund managers, strategists, analysts, Fed survey members, etc. Raised the possibility of recession to 36%. So nearly 40% of the survey now expecting a recession. Yet yesterday, we just had industrial production come out at an all-time record. So no sign of economic recession in terms of the economic data that's coming out, as industrial production is, again, doing very, very well. Retail sales came out this week, and core retail sales were up 1%. Again, no sign of recession in retail sales numbers. Certainly signs of slower economic growth. Again, the economy is slowing down towards 2%, but there's no indicators at this moment coming from either the employment front. Jobless claims remain very low. Unemployment rates remain very low. Our economic composite index is in positive territory, which is comprised of 100 indicators, both hard and soft. Leading economic indicators are improving. So again, it's an interesting situation that's set up, because just because we're instituting tariffs now, this is a recession risk. Yet during the entire first term of President Trump, when we were doing tariffs and having a trade war with China, the economy grew, inflation fell, and there was no sign of recession until we actually shut down the economy in 2020.
Now, do you think that like industrial manufacturing, some of that may be front ran because of tariffs? They're trying to ramp up things, get things out before?
It's possible.
Yeah.
But again, you in order to have a recession, you're going to have to see these indicators turning lower.
Correct.
Right? And you're just not seeing that yet. And again, it doesn't mean that they can't, and it doesn't mean that they won't. And we're certainly, and again, there's plenty of evidence that we're going to see slower economic growth this year. And this is one of the reasons that bonds have been rallying fairly well as of late this year in particular, is that slower economic growth is going to lead to lower inflation. We just saw the latest inflation prints, much weaker than expected. That's likely going to continue this year as we kind of move further into bringing rates of economic growth down to probably 1.8%, 2% on GDP growth is where we'll wind up in the next 2 years. And that's even in line with the Fed forecast.
Which is their target, which I still don't get. Pre-financial crisis, the target was like 4%.
Correct.
So what has changed so much outside of debt?
Well, that's the big one.
Yeah.
Right. That is the big issue, because debt deters economic growth, because you're extracting productive capital to pay interest on the debt. Right.
Yep.
So, but yeah, I know this is a very interesting thing. Now, you're very young, so you don't remember this, but
thank you.
Back in the 1900s, where Brent and I lived, the good old days. Cassette tape, 8-track tape players, right? There you go, the olden days. Back in those days, we used to have 5% economic growth, 2% economic growth back in the 1900s, late 1900s, was actually considered pre-recessionary. If you were getting 2% economic growth, that was a worry. Yeah. Right? At 2%, you're on the verge of recession. Now we're just hoping to get 2%.
Well, I can even remember early 2000s that was the case.
Yeah.
So, yeah, things have changed substantially. Now, do you think with the, potentially cutting government spending substantially, if they can reduce debt and deficits over time, will that be something that gets us back on track to something like that?
Well, yeah, but you're going to go through pain first.
Yeah.
Right.
How much pain is there?
Well, now look, so this is what we've talked about before. It's quite fascinating, actually, right? I mean, if you look what's going on right now, you've got an administration that's focused on cutting waste, fraud, and abuse out of spending, reducing the debt, reducing the deficit. Those have been kind of marked goals. We want to cut $1 trillion off the deficit. Yep. We want to balance the budget by the end of 4 years. And everybody's fighting them on it. But the same people that are fighting them on it now are the same people that were saying we need to do these things 4 years ago, right? Yeah. So, we don't, it's as is always the case, it's like, we need to fix Social Security, but we don't want to take any actions to actually fix Social Security.
Correct.
Because we don't want to give up any benefits or whatever. We don't want to have to have longer retirement ages or whatever. We all want this stuff to get fixed, but we don't want to take any action to do it. So to your point, if we're going to reduce deficits, we're going to reduce debts, we're going to balance the budget, that extracts capital from the economy. So you're going to have slower economic growth and you're going to have a recession. But that will set you up for much stronger economic growth in the future. Just like this, right? During
Well, who's a better steward of capital, you or the government?
Right.
Clearly, we know.
Well, this goes back to the financial crisis, and I've said this for over a decade now. Is during the financial crisis, we should have let J.P. Morgan, Bank of America, all these people just go bankrupt. Yeah. Right now, that everybody was concerned, it's like, oh, if you let those go bankrupt, it'll destroy the economy. No,
systemic risk with it.
Yeah. Well, which is completely untrue. Because what would happen is that if J.P. Morgan goes bankrupt, the FDIC steps in and says, okay, well, you're bankrupt, so we're going to take all your accounts and we're going to give them to all these other regional banks, and we're going to divide them up.
Which we saw.
Right. J.P. Morgan didn't go bankrupt.
Well, not them,
out,
but
right?
You had Washington Mutual, Wachovia, you had a number of them that did.
Yeah, smaller banks, right?
Yeah.
And so what did we do with those assets? We gave them to J.P. Morgan, to Bank of America. Merrill Lynch went to Bank of America, right?
Yep.
So we made these systemic banks even bigger. We have a much more concentrated banking system, which is predatory on consumers because they basically control the asset flow within the banking system. So it doesn't allow for fairer, freer competition among the banking sector, which would have been better for the global or for the economics in the U.S. Right?
Yeah.
So instead of allowing the financial system of capitalism to work, we morphed it in the financial crisis, which has now paid out to our detriment over the last 15 years. So that's why we're here.
Which essentially the Fed put, right?
Yeah. And that's all that stuff, all the stuff that we complain about right now started in 2008 during the financial crisis. And then everything that occurred after that, HAMP, HARP, TARP, all the bailouts, all the government assistance, quantitative easing, 1, 2, 3, 4, all that. $47 trillion worth of injections into the economy. Yeah, it's led to a fantastic stock market, but it also shifted all the wealth from the middle class to the rich. So now you got me on a soapbox. Anyway, back to Recession Watch.
Oh, man. But I think this is important because, a little bit of context around this. These are questions that we get often, so I'm sure many of you out there have those same types of questions. But, so when we're looking at this, and I think some of the other concerns right now, you have a lot of debt that's maturing, right? Mm-hmm. I think Janet Yellen did one thing really well, and there's not much, but she did refinance a whole lot of debt on shorter term notes, right? Which is great, but I think the anticipation was that we'd have more pain sooner.
Sure.
Right? So you'd have lower interest rates, and now you have Powell who, I don't even know what that relationship has to look like with him and Trump. Obviously it was contentious at the end of his term, or at least at the beginning, say, 2018, when he was trying to raise rates. Now you don't even hear Trump speak of them.
Right.
Very rarely.
Yeah. No, this is essentially akin to when my wife's mad at me. She just doesn't talk to me for 2 days. And that's kind of what's going on in the White House right now. Trump's not talking to Powell. Powell's not talking to Trump, but Scott Bessent is the head of the Treasury. They are talking. And if you listen to what's going on, Scott Bessent and Trump are talking very closely about the debt. And they are talking about the fact that they want to get the debt down. They want to get interest rates down. And they're talking a lot about refinancing debt, et cetera, at lower rates. So that's already kind of going on. And by the way, there's one big fallacy that's running around right now. I'm getting this a lot on Twitter or X or whatever you call it. There's $7 trillion worth of bonds that have to be bought this year. That's no big deal. These are all short-term bonds that are rolling over. And again, this is what Danny was just talking about. There's a lot of debt that was issued out in very short-term paper, and it's just got to get rolled. And everybody's like, well, who's going to buy that paper? The primary dealers will buy it. The primary dealers have to buy the bonds. And so when this debt matures, it will get reissued, and it will be bought by the primary dealers and distributed. So
maybe describe that process, because I think I'm hearing a lot about that as well, saying, hey, you know what, this interest rates, there's no way people are going to buy these bonds at 4. We're going to have rates higher at 6. But you look across the globe, we're still higher than most other countries, right? It's still a better suited investment than a lot of these other places as well.
Correct. Yeah, okay. We'll talk about it when we go back. All right. Don't go away. Be right back.
Life is an illusion. Can't you see that love is everywhere? Step into the confusion. Can't you hear the sound that's in the air? It's rock and roll. It's rock and roll. It's rock and roll. It's
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me. So yeah, just kind of picking up where we left off, just very quickly. Just if you don't understand how the bond market works, or let me back that up. This has nothing to do with the bond market. If you don't understand how debt issuance works, it's very important to understanding that relative to a lot of this headline nonsense that comes out in the markets. And again, the people that are issuing these headlines generally trying to scare you into something, trying to make the case for the world coming to an end. So, go buy, whatever. But you have to understand that. So when the Treasury issue, why does the Treasury issue debt? Let's start at the very basics, right? The Treasury issues debt to cover the differential between the revenues that it collects,
Your taxes,
right? The revenue it collects and the money it spends. And so right now, just as a function, if you take a look at the mandatory spending of the government, it takes roughly about 104% of the revenues collected just to pay for mandatory spending. That's Social Security, welfare, prescription drug benefits, the Affordable Care Act, and interest on the debt. So that takes about 104, 105%. Everything else, defense spending, Department of Education, Department of Energy, blah, 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 the stuff that Doji's trying to fix is all paid for by discretionary spending, and that basically requires more debt issuance. So the differential between what we collect and what we spend has to be issued out in debt. So the Treasury Department issues the debt. All money is lent into existence. Money is not printed. We don't have a magic printer somewhere just cranking out dollars. All money is lent into existence. So we have to issue debt in order to create money. In order for the government to issue debt, they have to sell the debt to someone, right? Somebody's got to be out there to buy the debt. So what the government did was they set up an organization of what's called primary dealers. And this was to make the job of issuing debt cleaner, simpler, more functional. They came up with this list of institutions that are considered primary dealers, and they sell the bonds to these primary dealers. These primary dealers then turn around and then sell the bonds to Danny and Brent and you. So when you want to buy, this is why when you go to the bond market and you want to buy a U.S. Treasury bond, it's issued either by the Treasury direct or by a primary dealer. I go buy a Treasury bond from J.P. Morgan or from Fidelity, wherever these institutional dealers are. These primary dealers have to buy the debt. They do not have a choice. So this idea that nobody's going to want to buy the debt is a fallacy because they have to buy the debt. Now, the price that they pay for the debt can certainly change, right? So that's why interest rates move up and down during a bond auction. You'll see these reports about, oh, we had a failed auction. That was because they tried to issue the bonds at some price, and then the dealer said, no, we want a lower price or a higher price, whatever it is. But that's what happens. So these bonds. So when we roll over $7 trillion worth of debt this year, it will get bought by either domestic primary dealers or international primary dealers. And when you start looking at the yields on bonds in other countries relative to the U.S., there's a lot of demand for U.S. Treasury. This is why you've seen U.S. Treasury demand go up a lot over the course of this year in particular, is because we're seeing a lot of demand for bonds because of the higher yield and the credit quality. And that's likely going to continue. So as you get into a slower economic environment, and if you get into a slower economic environment with more of a risk-off tendency within the economy, that's going to increase the demand for safety debt, for safe debt, right? So that'll be U.S. risk-free debt, that's U.S. Treasuries. So again, a lot of these kind of scare tactics, the government isn't issuing $7 trillion in new. They're not coming out tomorrow and saying, okay, I've got $7 trillion in debt. I've got to issue this today. Will somebody please buy it? That's not what's happening. Just these bonds are maturing on a regular basis. They're going to have to refinance this debt. So as the bond matures, they return the capital to the holder of the bond. They get their principal back. Well, what did most of those people do? They immediately turn right around and buy another one. Because this is pension funds, hedge funds, mutual funds, institutions, money managers, et cetera, that all require to have some type of treasury bond exposure on their books. So as the bond matures, they simply just have to roll it over and buy the new one. So it's just, again, this is just a function of the markets and how they work. And so a lot of these headlines that come out, they're great for eliciting fear and within the markets. And it's like, oh my gosh, this is going to happen. But you have to step back, understand how the bond market works, where the demand is coming from. Yes, interest rates are going to move up and down, but in the short term, they'll move up and down based on supply and demand. But then you look at where interest rates are going to be longer term. That only has functions to do with economic growth, inflation, and wages. So
I think
you got to kind of keep this all balanced.
Yeah, I think another big aspect of this is, look, there's a lot of debt that is maturing. I think many people are scared, like, oh, China's not going to buy our debt anymore. Foreign countries are not going to any longer. Talk about a little bit about why that's necessarily not true, especially being the world reserve currency.
Well, when we've talked about this a lot, right?
Yeah.
So like the dollar's been declining a lot lately. And which isn't surprising because the dollar had gotten exceptionally overbought last year, right? And just
for many years, really, we keep hearing the headlines of the death of the dollar, and yet here it is every year. It's still gaining traction,
right? And the dollar trades in a if you go look at a chart of the dollar, going back historically. Let me see if I can grab one really fast here. How much time do I have? I have a couple of minutes. Let me see if I can grab a chart here real quick on the dollar. If you go back and look historically at the dollar, hold on a second, bear with me just one moment. I'm sorry. Here we go. So this is a very long-term chart of the dollar, kind of going back. This only goes back 15 years. Let me see if I can get a little bit longer kind of time horizon. There you go, Brent. So this is a 30-year chart of the dollar, right? So this is a chart of the dollar going back 30 years. And what you can see is that over time, the dollar trades in just a huge range. But pretty much you can draw a line right through the middle of this chart and see that really the dollar is about where it was in the late 90s, right? And so all this talk about the death of the dollar or this or that doesn't really make any sense, because if you look back historically at the dollar, it just trades in a really broad range. Well, why is that? And that's because the dollar is trading against another basket of currencies. And again, as we talked about before, if you're going to maintain trade within the economy, if my dollar's too strong, that makes goods too expensive to export to other countries, right? They can't afford it because their purchasing power isn't there. So it's inflation on them. It's a tax on them when our dollar's too strong. If our dollar's too weak, it makes things more expensive for us. So what happens is that countries balance, and this was one of the fallacies that, Trump had talked about during his first term is like, China's manipulating their currency. We've been manipulating our currency since 1913 in the U.S. because we want to maintain a relative balance of our currency relative to other currencies. So we can, 40% of our revenue of corporations comes from exports. So it's very important to have in order to have good, strong trade relationships and a good, strong import-export balance, you want to have a currency that's reasonably trading against other baskets of currencies. And yes, it can get stronger or weaker relative to those other currencies. That can certainly happen. But again, if you go back and look at a really long-term chart of the dollar, historically, kind of going back in time, what you'll see is it trades just in a kind of a very big, broad trading range that sometimes is stronger, sometimes is weaker. Well, we had this super strong rally in the dollar. The dollar got too expensive relative to other currencies, and now you're having this correction in the dollar. So that is going to, at this moment, right, we've got money that's moving out of the dollar back into other foreign currencies. It's rebalancing the trade relationship, but eventually that's going to reverse here. And when money flows start coming back into the U.S. dollar, then that's going to start to benefit U.S. Treasuries, because how do I convert my foreign currency into the U.S. dollar? I buy Treasuries.
Yeah.
Right? And that gets me dollar exposure for my reserve currency. So
it's
again,
still from a volatility perspective,
yeah,
much less volatile and stable than most
sure,
other places, right?
Absolutely.
And so, the supply-demand aspect of it is something else that we're hearing quite a bit about, in the sense of like, well, if nobody's going to buy it. Well, okay, but if we're cutting government debt over time, and we're reducing that supply and demand equilibrium then begins to shift. And so that's one thing I think that a lot of these guys are just looking past, or it's more for headline news.
Right. Well, that's the whole point. Again, look, everything's about narrative. And in order to get clicks and views and, get people to watch our YouTube channel, whatever it is, like and subscribe, please. You
need to be more bearish, Lance.
Exactly. Well, no, that's, fear sells, right? If there's an old adage in the news community, which is if it bleeds, it leads.
Yeah.
And so, the gorier the incident, whatever it is, you put that right at the top of the hour, and that gets people to watch the news, right? Nobody wants to watch the news for feel-good stuff anymore, right? Here's little Jimmy. He just won the Nobel Prize at the age of 6. Nobody wants to see that, right? We want to see how many people got hit by a train last night. That's what we want to know. But that's the same thing in the financial markets, right? So we come up with these really bombastic headlines about, the dollar's declining. We're about to lose our reserve currency status. You better go do X or Y because of that. And no, you go back 50, 60 years, the dollar just trades in a very big range. Sometimes it's stronger, sometimes it's weaker, and that's just a function of economics. So got to keep this stuff in a little bit of perspective.
Yeah, good talk. Thank you.
Thank you. All right. Wraps up the show for the day. Be sure to like and subscribe to the channel. We appreciate it as always. And get by our website, realinvestmentadvice.com. And don't forget, Saturday, March 29th, that's not this Saturday, but next Saturday, is the Savvy Social Security Planning Candid Coffee with Danny and Richard. It's from 8 to 9 a.m. Be sure and register online at realinvestmentadvice.com. Send in your questions. We'll get them all covered for you live Saturday, March 29th, 8 to 9. See you then.